This is the most profitable wave in trading. Wave 3 is the core profit engine. It is never the shortest wave. It typically hits the 1.618 extension. Capture explosive moves with
Back everyone, you're tuning in to day 3 of our Time and Cycle Mastery Explainer. Over the last couple of sessions, we've been laying down the groundwork. The essentials of market cycles, structure, and the nuts and bolts of Elliott Wave Theory. But today, we are seriously elevating our focus. We're stepping right into the realm where all that theory translates into high probability execution. This is exactly where the professionals operate, and by the end of this session, you're going to have the exact framework they use to navigate the markets. Listen to this. This is the most profitable wave in trading. I really want that statement to sink in for a second. Today, we are focusing entirely on the absolute profit engine of the Elliott Wave Theory, which is Wave 3. It's universally recognized by market technicians and seasoned pros as the single most explosive, reliable, and lucrative price movement across literally any financial asset class. Here's our roadmap for today's session. We've got 1. The money wave. 2. The anatomy of Wave 3. 3. The unbreakable rule. 4. Fibonacci targets. 5. Spotting the setup. And 6. Avoiding mistakes. Let's jump right in. Section 1. The money wave. Recognition and execution. Okay, so right off the bat, we need to make a critical distinction. Mastering Wave 3 isn't about having some magical crystal ball. It's absolutely not about market prediction. It's entirely about market recognition and precise execution. Visualizing the structure is so important here. When you look at a standard 5-wave impulse sequence, you can't miss how prominent Wave 3 is right there in the middle. While Wave 1 just kind of kicks off a new trend and Wave 5 eventually exhausts it, Wave 3 completely dominates the primary direction. It is the longest, the strongest, and the absolute most impulsive part of the cycle. This is the wave that generates the massive price movements, and it heavily rewards the traders who know exactly how to catch it. Moving to Section 2, Anatomy of Wave 3, and Understanding the Crowd. To actually trade this wave effectively, you've got to understand the psychology behind it. Think about it. Wave 1 catches the early adopters, right? Then Wave 2 shakes out the weak hands with a sharp pullback. But Wave 3, that is the exact moment the broader market crowd finally gets it. The hesitation just completely vanishes, and it's replaced by pure, undeniable conviction. Based on hundreds of setups, every profitable Wave 3 shares 3 core pillars. First up, momentum acceleration. Unlike Wave 1, which can feel really choppy, or Wave 5, which often shows momentum divergence, Wave 3 builds this undeniable, relentless speed. Second is volume expansion. Real Wave 3 moves pull in massive market participation. We see this all the time in major forex pairs like URUSD and GBPUSD, where those extensions line up with huge volume spikes. And third, technical breakouts. The market literally shreds through major resistance levels and moving averages, fully confirming the wave's power. This dynamic perfectly matches a quote from our source material. Confidence in the direction of the new trend is clearly evident, and man is it ever. During a Wave 3 move in a broader stock index, nearly all stocks are going to participate in that rally or decline. Because of that, it's an unmistakable, highly volatile point of strength. You'll frequently see massive price breakouts and continuation gaps. The trend just isn't a secret anymore. It's a full-on broadcast. Section 3. The one unbreakable rule. Let's talk mathematical boundaries. So Elliott Wave Theory has plenty of guidelines, sure, but it also has absolute mathematical boundaries. And this is exactly what separates the disciplined pros from the amateurs who are just guessing at chart squiggles. The golden law is simply this. In any valid 5-wave sequence, Wave 3 can never be the shortest impulse wave. Never. It is an absolute constraint. Let's say Wave 1 travels 100 pips and Wave 3 goes 90 pips, but then Wave 5 travels 120 pips. Well, whatever you are looking at, it's not a valid 5-wave sequence. Your wave count is just wrong. Wave 3 must always exceed the distance of the shortest wave in the sequence. Most of the time, it's the extended wave, meaning it's the longest, but at the very bare minimum, it can never be the shortest. Section 4, Fibonacci targets and extensions, bringing in mathematical precision. Now, counting waves gives you great context, but as our sources heavily emphasize, traders who layer Fibonacci onto their Elliott wave analysis, they know exactly where to take profits. This right here is the secret sauce for mapping ultimate profit targets. 1.618. This beautiful golden ratio is your standard bread and butter extension target for Wave 3. When you measure the length of Wave 1 and project that from the bottom of Wave 2, Wave 3 typically reaches exactly 1.618 times the length of Wave 1. And hitting this standard target routinely offers traders massive 2-to-1 risk-reward ratios. But hey, it gets even better. 2.618. This is the extended target. Believe it or not, about 30% of Wave 3 setups don't just stop at that standard level. They explode all the way to 2.618 times the length of Wave 1, and sometimes they go even further. These extended waves are where the truly outsized returns live. They usually happen when the technical Elliott wave structure perfectly aligns with some major fundamental catalyst, like a big central bank policy shift or a massive earnings surprise. Section 5. Spotting the setup. Time for actionable execution. So the theory and the math are absolutely vital, but now we've got to shift to real-world application. How do you actually identify this explosive setup before the rest of the crowd rushes in? Well, here is your exact 3-step playbook. Step 1, Wave 2 completion. You have to patiently wait for that Wave 2 pullback to finish. The highest probability entries happen right after Wave 2 holds above the 78.6% Fibonacci retracement level of Wave 1. Step 2, Impulse acceleration. You want to see the price action aggressively surge out of that Wave 2 low, exceeding the speed we saw back in Wave 1. And Step 3, Volume confirmation. As that surge is happening, you need to see the trading volume visibly expanding, which proves that the big institutional money is stepping on the gas. Now, here's a massive pro tip to keep in mind. Look for shallow corrections. If you want to catch one of those huge 2.618 extended Wave 3s we just talked about, you really want to see a shallow Wave 2. If a Wave 2 only retraces 38.2% or maybe 50% of Wave 1, it's indicating extreme underlying market strength. Basically, the market doesn't even have the energy to pull back deeply. That shallow correction acts just like a massive coiled spring, signaling that a highly aggressive extended Wave 3 is right around the corner. Finally, Section 6, Avoiding costly mistakes. How to protect your capital. Spotting the setup is only half the battle. Avoiding the traps that constantly snare novice traders is how you actually keep your money. So let's break down the 3 biggest errors. First up, mistaking a Wave C for a Wave 3. In real time, a corrective Wave C can look incredibly impulsive, just like a Wave 3. But a C wave operates inside a larger correction, whereas a Wave 3 is driving a brand new trend. You always have to keep that higher timeframe context in mind. Second, chasing extended moves. By the time Wave 3 hits that 261.8% extension, it's highly likely exhausting itself. If you're entering late way up there, you are almost guaranteed to get violently trapped in the ensuing Wave 4 pullback. And third, poor position sizing. Over-leveraging just because you feel super confident about a wave count, that's the fastest way to blow up an account. Because the rules of Elliott Wave are so absolute, defining your risk actually becomes beautifully simple. Remember, a Wave 2 can never retrace 100% of Wave 1, right? Therefore, you just tuck your stop loss right below the Wave 2 low. It's that straightforward. By combining a tight, highly logical stop loss with those massive 1.618 or 2.618 profit targets, you're consistently setting yourself up for 3-to-1 or even 5-to-1 risk-reward ratios. You completely define your risk before you ever click the buy button. Well, we've covered the structural foundations, the crowd psychology, the unbreakable rules, and those incredibly precise mathematical targets that make up the most profitable wave in the financial markets. The math is undeniably stacked in your favor when you apply this system with discipline. You've got the blueprint now to recognize exactly when market hesitation turns into pure conviction. So the only question I have left for you today is this. Are you ready to ride the money wave? Take all these concepts, pull up your charts, and start hunting for that pristine Wave 3 setup. Thank you so much for joining me for this explainer, and I will catch you in our next session.